Reconstitution is out. So I want to get this out to you with the updates. I want to share with you what's been taken away as well as what's been added. Talk about the sectors, a little bit of the change that's taken place. I'll actually be doing a more in-depth where I'll be screen sharing, showing you some of the companies that were added and removed and why that is. In a couple days when the Q1 dividend comes out, I'll do a more in-depth full video on both the Reconstitution as well as the dividend for Q1. But today I just want to touch real quick on what some of the stocks are that are being taken out, and then what some of the stocks are that are being added. So I'll start with, there's 17 stocks that were removed from Schd. Again, for those who aren't aware, every year, the third Friday of March, Schd does a reconstitution. And they did this past Friday. It was made public this morning. And so here's the list of the 17 stocks that were removed from Schd. C.H. Robinson from Industrials, Dick's Sporting Goods, Zion Bank Corp, which is a financials, BlackRock, which was a 3.8% of the holding. So this was a big subtraction from this, and it reduces exposure to the financials. We're going to see a little bit on this as we go through this, what sectors were reduced, which ones were gained strength. Again, I'm just bringing this real quick today. I'm going over these pretty rapidly. If you have questions, any thoughts, throw them in the comments below. I'd be curious, which of these companies do you feel like, oh, they shouldn't have dropped that, or maybe they shouldn't have added the ones I'll be sharing in a minute on the ads. The fifth stock that's gone is Bank of Hawaii, another financials. Then you have Leggett & Pratt, a consumer discretionary. M&T Bank, which was 1.13% of the holdings. This is, again, another financial. Another larger drop was U.S. Bank Corp, a financial, which was 2.55% of the holdings. And this reduces exposure to regional banking, which has been very volatile. So this is one of the reasons this is out. Then you have number 9, Heritage Financial, obviously a financial company. Number 10, which was 4.3% of the holding, was Pfizer from the healthcare industry. And this reduces exposure to the pharmaceuticals volatility. And kind of what's happened with Pfizer, even though it's paid a nice dividend, their earnings are way down since the COVID spike, and everything's kind of come back down. The selling of the COVID vaccine, that really built up their revenue, and it's coming back down. So that's one of the reasons behind that. Number 11, you have Huntington Bank Shares, another financial. And then right along with that, you have H&R Block is gone, a financial. Then you have Tapestry, consumer discretionary fund, and Guess, which is a consumer discretionary. Both of these are out. So that's 14. Number 15 is Cracker Barrel, which is a consumer discretionary. So you see a lot, if you look at the companies I'm talking about here, a lot of financial and a lot of consumer discretionary. Synovus is a financial, and the number 17, Key Core, which is a financial. So as you're seeing, a lot of financial has been removed. And part of that, I think you'll see, is because of the continued inflation being high and the continued interest rates being high, that's creating a lot of chaos in the financial industry. And that could be one of the reasons why you're seeing a lot of that removed, as well as consumer discretionary, with a lot of fear with the market dropping, with a lot of fear of, possibly a recession. Consumer discretionary is something, that's why it's called discretionary. It's something that people don't have to buy. When you think of Dick's Sporting Goods, when you think of Cracker Barrel, people don't have to go out to eat. So discretionary spending is something that could drop during something like a recession. And that is why I think you're seeing some of this dropping out. And one of the reasons why we're going to see some of the financials dropping out as well is because the continued higher interest rates. So before I get into the sectors, I want to share some of the ads. We had 20 additions to SCHD. We'll go through each of those. And again, I'm going to bring more in-depth, like what percentage each one holds, and show a side-by-side comparison of the ones that were added, the ones that were taken away. But I just wanted to get this out today, being that this just became kind of public this morning. And I was thinking about doing one this evening where I do all the charts and everything, but I really wanted to get these out to you, get the information, and then in a couple days when the dividend comes out, I will go more in depth on both the Reconstitution as well as the dividend. So 20 of these, we have Halliburton, which is an energy, and so this is helping boost the energy exposure for SCHD. We have Signet Jewelers, Aventiv, an energy. We have Schlumberger Energy, which is going to be taking about 2.3% of the index fund. So this is a nice add to that. And so again, pay attention to what we saw with the removals, what sectors you see, as well as now what's being added and what sectors you're seeing. Let's see, we have Autoliv, which is a consumer discretionary, is being added. CNA, which is financial. Archer Daniels Midland, which is a consumer staples. Difference between consumer staples and consumer discretionary. Consumer discretionary isn't something people need. Consumer staples is more stuff that people need. Think of, food, even some clothing items can be in there, healthcare, like CVS, some of that can fall in there. That type of consumer staples are areas where people need to be buying regardless of whether in a recession or not. You have American Financial Group. You have FMC Corporation, which is a materials. First Financial Corporation. Federated Hermes. Here's a big one. It's going to be 4.54 of the holdings. ConocoPhillips. This is an energy sector, which is because of the strong cash flow and the dividend growth potential that ConocoPhillips brings. What are your thoughts on that one there? Throw me a comment in the chat below. Be curious, what do you think of adding ConocoPhillips, which is an energy sector? The 13th one we have here is General Mills. That'll get about 1.28%, somewhere right in there. That's a consumer staples. Again, the food industry, General Mills making all the cereals and that type of stuff. People are going to buy that regardless. Then you have Target, which is a consumer discretionary. Inner Perfumes, consumer discretionary. Here's another big one being added from the healthcare industry, Merck & Company, which is going to get 4.05%. And this adds a little stability and defensive positioning in the healthcare sector. So Merck & Company is a big add along with ConocoPhillips, both of those just above 4% of the holdings. What are your thoughts on those two being added? 17, you have Enos & Corp, which is industrials. Flowers Food, consumer staples. So you're seeing a few consumer staples being added in here. 19 is Moelis & Company Financial. And then the last one, Murphy, which is an energy, part of the energy sector. So those are the stocks. Those are the companies being added and removed. Have 17 being removed, 20 being added. They'll all be rebalanced based on, SCHD's guides that they use on, all the cash flow and all the different rankings that they use to see where that ends. I will do a video in a couple days. We'll have the chart with all the holdings, what percentage they hold, each sector and what percentage they hold. But real quick, let's look at a few of the sectors. The energy exposure increased significantly. If you noticed, a lot of financial was removed. Some was added, but quite a bit was removed. And a lot of that's being replaced with energy. It went from 11.6% of the holdings. Now energy makes up 20% of SCHD's holdings. So that's a big shift for energy, getting a lot of exposure there. There's a lot of talk on the energy front with tariffs and the drilling and all sorts of stuff going on in the global and political arena. And those things may really drive that. So we will see. And how do you feel about the energy sector increasing by about 9% of its holdings. Let me know your thoughts on that one. The second sector, the financials, that saw a little bit of reshuffling, but it also decreased from 17% down to 8%. So you see both, financials being added and removed, but more were removed, or they have lower weighting. The companies that were added were, much lower, and like BlackRock was 3.8% of the holding. You might get another holding brought in that only has like 0.4% or something. So even though there were several finances or financial sector companies brought in, they were brought in probably at a much lower percentage. So that dropped from 17 to 8% in the financials. The healthcare sector had a slight shift. It went from 18% down to 16%, so nothing significant there. That was one of the few changes there. There were a couple, pretty impactful companies within there removed and added, with Pfizer being removed, and that was, what was that, about 4.3% of the holding. So that was a big removal of there. I'd be curious on your thoughts with that. What was your outlook with Pfizer? And this is one of the things I love about ETFs. I don't have to go through all 100 of these companies that SCHD holds. I think it's 106 now. I don't have to go through each one of these and look at their financials. I don't have to look at their leadership. I don't have to look at their forecast. I don't have to track all of that, because the SCHD index does that for you. And sure, maybe they remove something that you think, oh, I should have held that. If you feel rock solid like you should hold a certain company that's been removed, that's where you can have a small percentage of your portfolio where you hold individual stocks. But the bulk of your holdings can be in index funds like SCHD or other indexes, where it does this work for you and it reconstitutes for you, and you don't have to monitor this. You don't have to worry about, is this company, is it a dip and I'm trying to get in and buy on the dip, or is it a knife falling and I'm trying to grab the knife and I'm about to slice my hand off? There's a difference between trying to, determine if a company's just in a dip, they're having a little bit of, issues, or if it's a major consumer issue. We don't have to worry about that with SCHD. It does it for you. Again, if you feel like a company that you just loved isn't in there anymore, have a little bit of your fund over to the side where you have a couple of your really, like, I love this company and I'm going to buy it even if it's not in my ETFs. And, but again, I would not put a lot. I wouldn't put a high percentage. I recommend, I think most people who are conservative investors for diversifying with ETFs, mutual funds, would say no more than about 10% of your portfolio should be made up of individual funds. Everyone's going to differ. This isn't financial advice. This is educational, entertainment. You're going to have to make your own decisions. That's just my opinion on that. And that's why I like ETFs, because all the hard work's done. I do this for fun. I share these videos for fun. But bottom line is, I wouldn't really have bothered looking at SCHD too much. I would have looked at it and said, okay, yeah, a couple companies were removed, a couple were added. I'm okay with that. I'm going to move on. I'm going to continue holding it, and I'm going to continue collecting my dividends. I'm excited because my next dividend comes out in a couple days. I'm anxious to see where it stands. It's typically in March a little bit lower than it was in December, but it's year over year. How is it from last March? And where am I in trajectory for the year 2025 on my dividends? I love the growth that I see, not only because I keep buying more, but I keep reinvesting the dividends, and those keep buying me more shares, and my dividend growth is growing. And you add all that together, and I'm just seeing my dividends snowballing, and it's great, seeing a check come in for $2,000, $3,000, $4,000, depending on the quarter, or what other indexes are paying me as well. The last one, the consumer staples gain strength, that went from about 15% of holdings to about 18.7%. So you see some areas, and I think consumer staples being gained is good in the market that we're in currently. I think this is going to be a good thing, because even though other areas may drop, people may hold their money, they may not spend. If we do, I'm not saying we're going to, but if we do have a recession, people will tend to spend less, That's what causes the recession, but they're not going to typically spend less on food, their staples, the things they need. So I think that's good to we have a little more increased exposure in that, as well as in the energy sector. I think we're going to see that could be a good opportunity in the landscape that we're currently in. So I like what I see. Are there a couple things I think maybe they could have kept that? Maybe we could see how that plays out. But I think overall, this is a great continuation of SCHD's strong performance, and I'm anxious to see and excited to see what it's going to do in the upcoming year. So again, I'm going to be dropping another video in a few days when the dividend comes out. Keep an eye out for that. Make sure you hit that bell so you're notified when videos drop. And I'll go through the dividend. We'll do our hypothetical portfolio that we have showing the dividend from when we originally started that and how that is growing with the new dividend that will be added. And I'll go through a little bit of this reconstitution in a chart side by side, so you'll have some more visuals for this instead of just having to listen to me. But I appreciate you joining me. Appreciate you watching. As always, hit that like and subscribe button, and we'll see you next time on Simply Money.